Good morning, everybody. I'm Isabella Kaminska. I'm a writer for the Financial Times. It's a real pleasure to have been invited to moderate this panel. We're going to be discussing how institutional investors can bring their portfolios into line with the 2-degree goal. And I'm especially excited to be here because I'm something of an outsider in my day-to-day role. I focus mostly on reporting on capital markets in the mainstream context. And it's actually in the course of preparing for this panel that I realized how far removed my world is from this world, and to what degree we are not cognizant of these issues on a day-to-day basis when we're reporting on the capital markets, and the degree to which we are still obsessed with a very low-yield world, and the idea that you can't have sustainability necessarily and high returns. So I'm very excited to hear your views on how we can achieve both, how we can have our cake and eat it. And I thought the best way to start really is to have a brief I'm just going to briefly introduce you all so that we get straight to the issues. So we're joined here, I'm going to go from right to left. I'm joined here by Anthony Hobley, CEO of Carbon Tracker. And then I've got, and apologies if I mispronounce your names, Martin Skank from the chair of the PRI board. Then we're focused on, then next in line we've got, oh my goodness, I haven't met, Matt Sanderson from AP4. Then we're in Felix Lanters, head of long-term equity strategy at PGGM Investments. Then we've got Priya Saramatha, from a member of the board at CalPERS, and Philip Zoati, CEO at Mirova. And on the far left, we have Miriam Belcois, president of Caixa Econômica Federal. So I just thought we'd start briefly with getting all of your perspectives, and a great place to start, of course, is with you, because Anthony, because you're obviously CEO of Carbon Tracker, and you have made a strong case for all of us being conscious of carbon tracking in our day-to-day lives and in portfolio investing. So could you explain the case for carbon tracking?
Yes, thank you. I mean, it is exciting to be here because I think we're at an inflection point. The world is changing around us. And people people who are involved in the day-to-day of business and finance don't always notice. And I think they haven't noticed, many of them haven't noticed that the world is changing. One of my favorite quotes is the chairman of Baldwin. Now, if you've been in the financial markets late 19th century, early 20th century, you've known Baldwin, one of the biggest US companies for 30 or 40 years in the Dow Jones, the second biggest manufacturer of steam locomotives and everything you needed to build a railway. In 1930, they had to defend a massive investment program in the latest generation of steam locomotives. And their chairman made a big speech on Wall Street to the effect that these new automobiles, this General Motors and Ford that had just entered the Dow Jones, don't worry about them, this is a plaything of the rich, it'll never catch on. Mark my words, steam locomotion will be the dominant form of transport well into the 1980s and beyond. And we hear similar defense now from, let's call it the carbon-intensive industries. I heard the CEO discussion yesterday with Paul Polman, Unilever, RWE, Total, and there was still this sort of, I think, out-of-date proposition that fossil fuel-based energy is the answer to energy poverty. It's not. Our financial analysis, and that's what we do at Carbon Tracker, we do financial analysis. We look at the numbers, the finances, tell us in most cases at the moment, the cheapest option for the energy poor is renewable energy, solar. And soon, it'll be the cheapest option in all cases. Our financial analysis also tells us that the momentum, the sort of, to some degree, systemic laziness in the financial markets is allowing many companies to get away with pouring billions, potentially trillions of dollars into high-cost, high-carbon projects that don't make financial sense now under the current policy settings and will make even less sense as we go forward. And there's a real risk here, what we call in the UK a sort of colloquial term, a double whammy. Because if that money gets poured into those projects, it potentially gets destroyed, so we destroy all of that value, and then we still have to find that money to fund the low carbon transition. So let's divert it. Let's make sure investors really understand the true fossil fuel risk premium. I mean, and they get the right information, and that's why there's an important role for financial regulators, so that investors truly understand the risks that now are inherent in fossil fuel investments. And we move forward. We no longer talk about this in historical terms, that it's about fossil fuels solving poverty. It's not. It's clean energy solving poverty. And that the climate option, the climate secure option, costs money. I think in many cases we're finding the clean technology is increasingly cheaper than the historic high carbon options. So my point, the world is changing. Let's ensure the financial markets and the business community catches up.
Thank you. Perhaps, Martin, in your role, obviously as chair of PRI, you have important insights, but also as in your role previously in the Norwegian Government Fund. Just wondering if you could offer your perspective on how we can achieve some of these goals.
Thank you, and thank you for the invitation to come here today. So I think it's important first to distinguish perhaps between two different questions. So it says, how can, the title of this discussion is, how can investors bring their portfolios in line with the 2-degree target? So one interpretation of that question is, how can individual investors bring their portfolios in line with the target? And the other question is, how can investors collectively bring their portfolios in line with the 2-degree target? And those are very different questions. Because obviously, at the individual portfolio level, you can divest or you invest in low carbon intensive sectors and bring your individual portfolio in line with the 2-degree target. But divestment means selling to some other investor. So while you're decarbonizing your portfolio, by definition, some other investors must be recarbonizing their portfolios. So I very much agree with the perspective that Anthony drew up, which is that carbon risk is created by the investment decisions of fossil fuel companies. And if they are investing in a way which is not compatible with a 2-degree target, they're building up carbon risk in the financial system. And this is a very real risk factor. So we need, as investors, to address that risk by engaging with fossil fuel companies on their future investment plans. And I think we've seen some very promising developments looking at the shareholder resolutions been passed in BP, Shell, Statoil, which require these fossil fuel companies to stress test their portfolios against a 2-degree scenario and report back to investors. And I think the natural next step for investors will be to say, well, if your investment opportunities are not compatible with a 2-degree target, then we as investors would like you to pay out the cash that you have to us in the form of dividends, so that we can reinvest in something which is sustainable and compatible with long-term climate objectives. So I think a lot has been said about engagement, and thinking about engagement, well, we cannot engage with a coal company and make them become a wind power company. I don't think that's what it's about. Engagement is primarily, I think, from an investor perspective, or not primarily, but an important part of engagement for investors is to engage with corporations on capital structures and dividend policies, because that will directly affect their investment capacity. Having said that, I think there is absolutely room for a whole range of different tools that investors can use. And I think they fall in 4 broad categories. And together with some partners, we will be launching something called Investors on Climate Change Platform, which will probably be announced later. But I think they fall in a broad this is supposed to be a toolkit for investors. And there are 4 broad categories. One is measurement, which is measuring carbon footprint, which gives you a tool to understanding risk in your portfolio. We launched the Montreal Pledge at the annual meeting of the PRI in Montreal in September of last year. The pledge and our target was to get $3 trillion signed up to the carbon pledge. We're a little over halfway there, and we're still hopeful that we will get to the $3 trillion mark by the time of the COP21. And if any of you haven't signed up yet, this is a time to do it. The second category is engaging, and the PRI is running an engagement platform where investors can sign up and do engagement. We have several that are related to climate and fossil fuels. We have one on fracking. We have on lobbying, which I think should be a very important issue for investors to make sure that fossil fuel companies are not using shareholders' money to lobby against the long-term interests of shareholders. The third category is mitigation, which, and we'll probably hear more about, at least in the last session today, about low carbon indices and other forms of ways that you can redress the balance of risks in your portfolio. And the fourth, of course, is investment. Investing in the new low carbon sources of energy. So I think there's a whole spectrum of tools. Maybe divestment is the most media-friendly tool because it's so visible. But I think as investors, we need to realize that there are very many different tools, and the role of the PRI is not to advocate one particular tool over another, but more to disseminate experiences, learning, and make sure that investors have a good understanding of the tool and the toolkit that's available to them.
Thank you. Mr. Anderson, you come from the perspective of a pension fund, and you believe that it's really a fiduciary duty to address sustainability if you're going to achieve those fiduciary duties, basically. Could you offer some perspective on how you are going about that?
Thanks for inviting me. I think there's three steps that can be taken by, three steps that should be taken by pension funds on the trip to a more sustainable world and trying to keep the degrees below the 2 degrees. Number one is disclosure. And I've been surprised for many years that institutional pension funds can get away without declaring the risk to climate. You ask them to declare risk in financial terms and you get it, but on climate risk you have nothing. So I'm a great supporter of the Montreal Pledge. I think the starting point is to declare your carbon footprint or your risk or exposure to the climate risk, to know where you are on the map. And I must say I admire the French government in taking the step to make this mandatory. Excellent. So that's the first step. The second one is to start decarbonizing, and I think it's our fiduciary duty actually to address this risk and to lower the carbon footprint. We've been doing that at AP4 for the past 3 years. We lowered the carbon footprint by 30%. The most important thing on this is actually it has enhanced our returns. There is a misconception that sustainability and good returns, there's a conflict. It's the other way around. Sustainability is a driver for good returns, not the other way around. And also must say that there's not one silver bullet. I think that pension funds should use whatever strategy they want, be that exclusion, be that engagement, be that decarbonizing the way we've done, whatever. The third step on this trip is to share your experience with others. And AP4, together with Amundi, CDP, and Unify, founded a coalition that was announced at the Climate Summit in New York last year, where we're trying to get $100 billion of US dollars that are put into low carbon strategies. And I'm happy to say that we're halfway to that target now, and I hope that we will deliver the $100 billion by COP21 later on this year. So these are the three steps in my view, and I'm happy to say, being in Paris, that both FRR and ERAF have joined this coalition. Thanks.
Thank you. Felix, you represent obviously PGGM, but you take a more of a positive impact approach. Perhaps tell us more about your view and your perspective about how your strategy compares to the ones already we've heard of.
Yes, thank you. I work with PGGM. We manage the investments for a number of large Dutch pension funds. By far the largest is the Dutch care sector pension fund, PFZW. We have a few large funds in Holland. This one is 180 billion euros. They have committed themselves to halving their CO2 footprint between now and 2020 and increasing the impact investment side fourfold. Currently 3% of their assets are invested in impact investments. That should rise to 12% by 2020. I'm working on that side. We have a new mandate from PFZW and now we're starting up to build a listed equities portfolio of companies that have enough impact on some of the main issues that the world is facing, one of them being climate change. That's very much a new field. We've tried to look at the outside world, external managers with experience in this field. We have found very few of those, actually none with any real experience in mainstream listed equities. So we have to build that trail while we go forward in the coming years. And that is very much the trailblazer for also the other asset classes, where I guess it will be a challenge to find enough impact investments to fill the requirements of PFZW.
Thank you. Priya, you represent one of the most famous pension funds in the world. So what are the key areas that you are looking at in your approach to achieving this target?
Well, thank you. First, let me just say that c'est un grand privilège de me trouver parmi vous ici pour discuter de la question pressante du changement climatique. Paris est depuis longtemps un haut lieu de la facilitation des discussions et débats en ce qui concerne les questions publiques au cœur de l'actualité. So I'm so thrilled to be here with all of you. Well, and thank you for your indulgence with my very poor French. But yes, CalPERS has for a long time been very committed to this space. We are, as you may know, a founding signatory of the PRI as well as of Ceres. And I believe someone from Ceres will be speaking a little bit later today. But we are not quite, I think, as far along as Mats is in regard to decarbonization. We have committed through the Montreal Pledge to doing a full carbon footprint of our entire portfolio, not just of the public equities. And that we expect to wrap up by the end of this calendar year. And in addition to that, we have sort of a three-channel approach to climate change and climate risk. First is in the area of public policy. So we are advocating very strongly for carbon pricing and for a cessation of subsidies for fossil fuels in the United States. We are also, as many of our friends in this space are doing, actively engaged with companies. So in fact, in the area of climate change in particular, we're partnering with about 70 different large asset owners around the world to engage 46 different fossil fuel companies, really pushing them to do a better job of doing risk analysis and incorporating climate risk into their risk analysis and their long-term business planning. We've made some progress. We have much more work to do in that regard. But that is just one example of sort of the corporate engagement side of what we're doing. And then we're also working very hard at CalPERS to integrate climate risk and other environmental, social, and governance factors into our investment decision-making. We are right now just finalizing a set of what we call manager expectations, which is a questionnaire and requirements for managers, for external managers, and also looking inward at our own internal investment management team around environmental, social, and governance factors and requiring a certain amount of disclosure, analysis, and integration of ESG into investment decision-making, both on the risk side, which obviously we see it as a very long-term risk facing pension funds and such as CalPERS, which are perennial organizations, pools of capital, but also on the opportunity side, which we do believe that there is a growing body of opportunities in this space. So look forward to talking a little bit more about that as we move forward in this panel. Thank you.
Thank you so much. Philippe, you represent Mirova on the asset management side. Therefore, where are you coming from when you look at the targets and how we can achieve them?
Thank you. Good morning, everybody. So just a word, Mirova is a subsidiary of Natixis Asset Management. So it's an investment management company dedicated to responsible investments. So what we do, what we offer to our clients and investors are conviction-based products across asset classes, now as well as listed equities, bonds, infrastructures products as well. In all these products with underlying philosophy, which is that we want to integrate with a very high conviction environmental and social criteria in the way we decide to invest in companies or in projects. So we think this is really very important and a good way also to answer to the issue of climate change and energy transition and so on. By the way, I think we are speaking about risk a lot. I mean, since the beginning of the session to this morning, I'm just wondering if we're all speaking about the same kind of risk. What does it mean? What does it mean really risk? Because we in the finance industry were sometimes often looking at ourselves a lot and not that much to the impact we have on the economy, and so the risk for the finance and industry is often too much the tracking error versus indices, for example. This is the way we measure risk, or the risk that there will be some regulation on carbon, and that this regulation will have some impact on the valuation of our portfolios. This is the kind of risk we see. I'm not sure that when Cristina Figueres spoke about the risk a few minutes ago, she was speaking about the same kind of risk. She was speaking about the big risk, the risk of the climate, the risk that we are all facing. And so we think that the way we are building our products should much more try to avoid these big risks than only the financial risks we are always looking at.
Thank you very much. Miriam, you come at it from a very different perspective. You have a mandate that is focused on deforestation as well as sustainability and renewables projects. Could you tell us more about where Caixa is working in this area?
Sim, bom dia a todos e todas. Um prazer estar aqui, obrigada. Para contextualizar, a Caixa Econômica Federal talvez tenha que esperar um pouco.
I should have said we should be using headset translation. Thank you.
Obrigada. A Caixa Econômica Federal é o terceiro maior banco brasileiro. Ele é um banco 100% público, tem mais de 100 mil empregados diretos e, em função de sua característica especial de ser um banco público, ele é um parceiro estratégico do governo federal para implementar políticas públicas, tanto sociais como o conhecido Bolsa Família, mas também financiamento para obras de infraestrutura em todo o país. A Caixa eu poderia dizer que tem duas linhas de ação fundamentais. A primeira, análise socioambiental, no que nós estamos discutindo aqui hoje. A primeira, análise socioambiental de empresas e projetos. E a segunda, propor e desenvolver soluções aí estratégicas sustentáveis, inicialmente como projetos piloto, que depois podem ser adotadas pelo governo como políticas públicas de caráter nacional. A Caixa signatária dos principais programas de responsabilidade socioambiental, Pacto Global da ONU, o Pacto Verde dos Bancos Brasileiros, organizado pelo Ministério do Meio Ambiente do Brasil, os princípios do Equador e também os princípios de investimento responsável, PRI, da ONU. Nessa análise que fazemos socioambiental, desde 2008, a Caixa foi o primeiro banco brasileiro a exigir licenciamento ambiental de operação de todos os projetos que financia. A Caixa exige um padrão de desempenho socioambiental para project finances maiores que 10 milhões de dólares e para empréstimos ponte maiores que 100 milhões de dólares. Além disso, fazemos uma análise minuciosa de empresas de setores com maior impacto ambiental, como mineradoras, frigoríficos, indústrias, e exigimos essa análise socioambiental para projetos maiores do que 3 milhões de dólares. Mas acho que o que, além dessa tarefa, que me parece comum, uma iniciativa comum no setor financeiro, a Caixa tem essa especificidade de desenvolver projetos piloto para virarem políticas públicas de caráter nacional. Para um país que tem um território gigante e 200 milhões de habitantes. Então, queria aqui citar 3 exemplos de iniciativas desse tipo. A primeira, que é sistema de aquecimento solar para água. Nós temos um programa habitacional gigante no Brasil, chamado Minha Casa Minha Vida, e o uso desse sistema de aquecimento solar é obrigatório para todas as casas térreas, por enquanto, e significa uma redução de 24% do consumo de energia das famílias atingidas por essa iniciativa. Essa já é uma política implementada em caráter nacional. Além disso, queria citar 2 outros exemplos que são as primeiras experiências, projetos pilotos, mas que já foram identificados como grande potencial de replicação, como uma usina solar num condomínio habitacional de população de baixa renda, com mais de 1.000 unidades, em que, em um ano, já teve uma receita de 500 mil dólares, que é dividido por um fundo de manutenção e investimento no próprio condomínio, e a outra parte serve como renda para os moradores. Então, esse é um jeito de inclusão social, mas também aqui de melhor aplicação dos recursos ambientais. Além disso, também uma outra experiência, que é de financiamento para a gestão de resíduos sólidos, com reduções certificadas de emissões, RCE, registradas no MDL da ONU. Já financiamos o primeiro projeto, um projeto do maior aterro sanitário do Brasil, no Rio de Janeiro. Foram 150 milhões que usaram os RCEs como forma de financiar. Já temos um segundo caso sendo estruturado. Obrigada.
Thank you very much. Let's have a more of an open discussion now. I thought you've raised very important points, all of you, but this really is about the tools that investors should be using. And one of the biggest issues is divestment, and Martin, you've already raised some of the key points. But I was just wondering, could you take us back to why it is so important that the aggregate picture has to be taken into account?
Yeah, so I think when we talk about the risks to the financial system, we're talking about so-called carbon bubble, the building up of carbon risk in the system, which is simply due to the fact that carbon or fossil fuel companies are investing much more in fossil fuels than is economically sustainable. And we know that when we have climate policies that will take us, hopefully, towards the 2-degree target, many of these assets will no longer have economic value. And that will lead to, that obviously leads to economic loss, and we have capital being diverted to investments that will probably not yield any returns to investors. And I think it's important to understand why this is happening. And I think there are two main reasons. One is the mispricing of CO2 emissions, that we have the price of CO2 emissions does simply not reflect the social cost of emissions. And the other, and this is amplified by the fact that there are so-called principal agent problems in the relationship between the owners of companies and the managers of companies, and that goes for fossil fuel companies as well. So if you're a manager of a fossil fuel company and that is your life and your livelihood, you may be incentivized to reinvest a lot of the money that you're making in sustaining that business, even if that is not in line with the long-term interests of your shareholders. And that's why shareholders have to be so vigilant. And that's why, for historically, looking back over the 400 years that we've had these types of listed public corporations, we've had I think in all countries, the issue of dividend policy, capital structure is reserved for shareholders, because it has been understood for several hundred years that that's not something that you can delegate to the companies themselves. Shareholders decide on dividend policy. They decide on capital structure. They decide on whether the company should be getting new equity in the form of a public offering. So it has been understood for centuries that capital structure is something that investors have to decide. And that's simply not something that can be delegated to the companies themselves. And so I think this is not really a new tool. It's just using an old tool to address a new problem, which is the building up of carbon risk. And I think it's important then to understand that if you talk about divestment, that can be a useful tool at the level of the individual portfolio. But obviously, all investors cannot divest simultaneously. That transaction requires someone at the other end who's buying those assets. So if you're looking at what investors can do collectively, I think we need much more emphasis on, in particular, dividend policy, capital structure. And this is not a revolutionary new thing. It is something that has been at the center of corporate governance for 400 years. We're just applying it to a new set of problems.
Anthony, you're keen to add to your...
If I could, I guess representing Carbon Tracker, the people who bought you the carbon bubble, not literally, I hope. I'd like to say something about this, because I think it is important to understand what we mean by the carbon bubble and how divestment and engagement fits in to this. I think the point made about shareholders is critical. I think for many years we thought about business and finance as one entity. People haven't really understood in many ways outside the financial community that finance is in many ways very different and distinct from business. And it's finance that effectively owns, through shares and asset management and so forth, the companies. And the companies can only go so far without the acquiescence, support, encouragement of those who ultimately own them, the shareholders. That's why the engagement, with the asset owners, the shareholders, the pension funds, the portfolios, is so critical. And for the shareholders and owners to understand what's at stake, the value of their investments. And what the carbon bubble represents is a huge risk to the value of their investments, value at risk. And it's this word of risk. So how does the carbon bubble represent risk and risk to value? Well, it doesn't necessarily represent a risk today. There's going to be no carbon bubble that bursts today and creates a financial crisis. I think one of the ways to think about it is you've got a carbon bubble that we're beginning to inflate. Or put another way, there's a carbon overhang that every day, week, month, and year we delay action is going to get bigger. And it's that inflating carbon bubble or carbon overhang that will build up the risk. And I heard from the French Finance Minister, Michael Sapin, and Christiana Figueres, this issue of the orderly and the disorderly transition. It's a message that we've been talking about and written some blogs on this week, if you want to sort of understand that in more detail. it's this issue that we've got a choice, and I think, but we're at the last possible moment to exercise that choice. We can choose to have an orderly transition over the next 20 to 30 years where we scale back from fossil fuels. We don't switch fossil fuels off overnight, but we scale back, we shrink the fossil fuel industry while we simultaneously grow the clean side of things. Or we can put off action. We can yet again, as we did in Copenhagen and various other meetings, kick the can down the road. That raises because we're at that last possible minute for the orderly transition, that raises the risk and the probability of the disorderly transition dramatically. And that risk will go up almost exponentially with every week and year of delay. And it's that disorderly transition, that moment in the future, and I guess I can't swear, but we have our oh God moment, come to Jesus moment, and there's obviously another expression that I won't use in public, where we realize what's at stake and we act. And it's a sort of panicked reaction. We saw what that looks like in 2008, 2009 with the financial crisis. We've seen what that looks like in gearing up for World War II, and I think that analogy was used yesterday. It's that sort of scale of reaction, and that's what would create stranded assets, financial dislocation. It's a threat to the system itself. And just in terms of divestment and engagement, both are incredibly useful tools. My analogy is that engagement to date has been a bit fluffy and around the edges. The engagement has to go to the business model. And engagement without a strong divestment movement is a little bit like having a criminal law statute without a criminal justice system to enforce it.
Thank you. The thesis that so many of these assets are basically mispriced and that there will be a realization moment, an oh God moment, does that not in some ways potentially encourage a disorderly transition? And from that perspective, is there a role in perhaps being more open-minded to the incumbent fossil fuel companies and understanding that they are also in a position where they can help in that transition? And Priya, I was thinking more on the active side. Is there something we can do to involve and encourage the incumbent fossil fuel companies who have all the infrastructure, the manpower, and even the tools to educate and change skills?
Yes, so I mentioned earlier in my opening remarks the Climate Asset Risk Initiative, which is a coalition of 70 asset owners who are engaging with fossil fuel companies globally. And we are trying to push for better risk analysis and business plans that account for climate risk over the long term in the annually disclosed financial reporting of these companies. But we're also, so our top two priorities for this 2015 corporate proxy season were climate change and proxy access. And in the United States, many asset owners have been fighting for quite a long time to be able to run potential directors on the corporate proxy itself. And we've gained quite a lot of traction this year. And so we see that as another way to really influence and ensure that our viewpoint is being adequately represented on corporate boards. And our viewpoint, of course, includes this thinking around climate risk and climate opportunity. So those are sort of two key areas, I think, in which we're engaging. As you all probably are very aware, there's been a huge push towards divestment in the United States for large pools of capital, particularly public pension funds and endowments. And we, CalPERS, we've sort of stood strong in our position that engagement is where we can add the most value. But I personally believe that there is a role for all these different approaches. And in fact, the whole divestment approach and the push for divestment helps bolster our position as a large asset owner who's focused on engagement, and helps to generate, I think, a more collaborative atmosphere with some of these companies that we're trying to influence.
Matt, you wanted to add something?
I don't think there's one strategy that should convey, be that engagement or exclusion. But I think as long as you are investor and you engage, I think you take it a step further from just having a view on the dividend and the capital structure, I think we should have a view and really influence who's going to be on the board. The Nordic governance model is that you actually have a real vote at the AGM. But the further away you come from the Nordic region, the less you have to influence. And I mean, US is, in my way, the companies have been hijacked by the management. But I mean, it's us as owners that should actually put climate on the agenda, make sure that you have people on the board that can take this seriously further. And then just one word on risk. I mean, risk is defined by the financial industry as volatility. To me, risk is a permanent capital loss. Volatility will not kill us. Climate risk could.
Speaking of risk, one of the issues really also is if we pull capital from one area and just plonk it into a new, still fledgling alternative area, is there even enough assets on the clean energy side to absorb all that capital if we got our wish? I was wondering if, Philippe, you have any views on the risk involved there?
I mean, if I may, I think the debate about divestment and also decarbonization, it's a little bit theoretical. I mean, we are speaking about shifting the trillions here. So what clearly we need, it's not to decarbonize our portfolios. It's to use our portfolios to decarbonize the economy. And I think this is it makes a very big difference. So what really is important is that we create a big shift in asset allocation. We need a change in asset allocation. We need to invest. I mean, we know what we need in order to tackle climate change as investors. We need to invest in renewable energies. We need to invest in energy efficiency projects. We need to invest in innovative companies that will find new technologies, new products, new services that will be helpful to as well mitigate or adapt to climate change. That's what we need to do. So, and that I mean, that means that we need to probably change a lot of things in the way we manage our portfolios. So again, measuring and so of course, clean energy is one of the areas where we need a lot of new investments. So again, measuring the carbon footprint is very good, and we have just a precision about what has been voted yesterday by the National Assembly. It's not only measuring carbon footprint, it's also asking the investors to explain how they integrate environmental and social criteria into their investment decisions, and also the law asks the institutional investors to explain how much they will invest in positive assets, I mean positive in terms of energy transition and tackling climate change. So it's not only just measuring carbon footprint, which is a first step, but a very first step. And then we can also argue that I mean the tools that we already use to measure carbon footprint are also really problematic because a lot of these tools are only measuring the scope, what we call scope 1 and scope 2, meaning direct emissions. And it's very important also to integrate not only direct emissions, but the emissions which will be avoided by the product and services which are proposed by the companies and the project. And we think that this ratio, carbon emissions and emissions avoided is probably a most powerful tool in order to redirect a lot of investments towards clean energy and other projects like that.
I mean, perhaps give us some more examples, though, of where we go wrong in assuming some companies are green and actually they're not as green. You raised sort of an example between allocation from maybe cement companies to banks.
Yes, because I mean, if you use, for example, only direct emissions, and it's very easy to decarbonize a portfolio. Decarbonize the portfolio, and if you shift a little bit of your portfolio from cement companies or oil companies into media or even banks, because it seems that the carbon impact of banks is very low, So if you just shift a little bit of your portfolio from cement to bank, then you will have decarbonized your portfolio. And what is the impact of that in terms of energy transition and climate change? I mean, absolutely nothing. It's a first step, but it's clearly not enough. What we need is to redirect into positive projects and companies, and we know what kind of project it is.
So in terms of what constitutes clean energy investments and the measurements that we need, this is clearly a topic that the industry has to tackle. What is the best way for you all to work together to achieve these sorts of standards? Does anyone have a view on the metrics side of this? Mats, do you have any?
Well, I would say that the best way, if you want to get money reallocated into renewables and more carbon efficient investments, I think is to put the right price on carbon. And I've raised this before. I mean, I think it's an argument of moral as well. We know now, at least we haven't got an estimation, it's 5.3 billion is they call it subsidy, but to me it's the cost that we are, as we speak, pushing to the next generation to pick up that bill. And I think that's totally out of order. And if you put that a real price on carbon, you will see massively investments in renewables, and you will see a totally different portfolio structures and investments among pension funds. But the sooner we can, and we don't need to wait for that, we should act already. But I mean, that should be the really, if there is one silver bullet, it's the price on carbon.
Yeah, I do agree on that, but currently there is still an issue. I mean, there's no way in which we could divert the trillions invested in traditional carbon industries into new projects. I mean, even in the current circumstances, we're doing the inventory to help our client increase their impact investments fourfold. Climate is a very important part of that. There are just no projects large enough and without compromising standards of return and risk to fulfill the requirements, and that's only PFZW in the Netherlands. So a lot needs to happen before we can begin to do that, a real transition into opportunities, and there will be a wealth of opportunities, and it's very exciting to talk about that. This creates massive investment opportunities.
Anthony, you have something.
Sorry, could I just be a bit challenging? I want to bring this back to the reality now that many fossil fuel projects do not make financial sense now. Yes, the price on carbon is important. It's incredibly important to drive, the scale of transition that we need at the speed that we need. And yes, this is a moral and ethical issue without doubt. But it is also a financial risk issue under the current policy settings. If we have no more climate change policy, no more technological evolution, there are still a whole bunch of projects that fossil fuel companies are pouring billions into, 6 to 7 trillion over the next 10 years, when we can't even burn at the vast majority, the 1/3 of the fossil fuel reserves we already have, but don't make sense. So in our carbon supply cost curve work, so our financial analysts, all former investment grade financial analysts from places like Barclays and Citi and Deutsche Bank, when they bought the Wood Mackenzie and Rystad databases and they ran the numbers, so this is the financial numbers, this is financial analysis, we came up with a carbon supply cost curve that showed there was a whole bunch of projects, that would require a oil price of somewhere between $90 and $200 a barrel before they would ever make money. Yet, the major oil companies, and there's similar issues in coal, possibly in gas, we've yet to publish that report, but they're getting away, their shareholders, the people who own them, are allowing them to do this. And what that is doing is it's suppressing share value, it's suppressing their ability to pay dividends. So if you were to engage and force them to divest at a project level from the high cost, high carbon projects, that would be good for your investors, for the people whose money that you manage. And I guess the question is, why is there not engagement at that level? And the real issue is, again, as I said earlier on, the risk is that that value gets destroyed, and we have to then find it anyway to fund the low carbon transition. Why not divert it? Even if it's diverted to retail or IT, it's better than being ploughed into high cost, high carbon fossil fuel projects. So I come back to the issue that now, right now, the financial markets are not correctly pricing the fossil fuel risk premium. And that means the fossil fuel industry is getting capital much more cheaply than it should. That means the investment playing field is tilted again, unfairly tilted against climate finance. So, one thing we can do is ensure the financial markets correctly price that fossil fuel risk premium. And in one sweep, we level the playing field. And all that stuff we're doing to make climate finance more attractive will have, orders of magnitude more impact.
Mats, you'd like to respond?
I totally agree, but if you want to stop investments, you need to get into the board of directors. So, i.e., if we want to stop this, we need to make owners accountable for the company. And the way to do that, again, is to make sure that you've got the right board of directors, and you need to have governance models that actually allow owners to have a view on this. And I'm prepared to fight for that every day of the week. But at that point, you actually will get the right people on the board, and you will not do silly investments.
I agree. I mean, the board is important. But what we have been told by people who understand oil and gas companies and mining companies is also the governance structure is important. That's why we've just written our blueprint report on how you hardwire the management of climate risk into the governance structure of an oil, gas and coal company. And I think I'd recommend, obviously, you read that report, but that's how you'll be able to judge when that oil and gas company is telling you, yes, of course we manage climate risk, it's part of our ESG. You'll be able to say, well, look, okay, do you have this in your risk matrix? What are your first and second order responses? Who's responsible for that? I think that hard wiring of climate risk into their governance structure is a critical first step.
Yeah, I agree with that, and I agree with Mats that I think this is, obviously there is a misalignment of economic incentives due to the fact that we haven't put a proper price on CO2 emissions. But there's also a more general issue of governance, and the one problem is amplified by the other. And I agree completely with Anthony that there is a risk that money that is actually owned by investors is being now invested in projects that will have little economic value in the future, or that has little value in net present value terms, or zero value in net present, or negative even.
Just look at Just look at the financial performance of many of those large energy companies over the last 5 or 6 years.
Yeah.
And one key reason, we think, is that they're punting forward revenues from existing oil and gas resources up the cost curve into high, very high cost in some cases, projects at the top end of the cost curve.
And it reflects a misalignment of incentives and the fact that there is the interest of the managers of these companies is not properly aligned with long-term interests of shareholders. And shareholders have to do something about that. But it is a much broader issue that has to do with corporate governance in general.
Felix, I was just wondering, in terms of, pulling capital, again, it's a great idea in principle, but you're raising the point that we don't have necessarily, even if we're putting it into media and telecoms or neutral corporations, supposedly, there isn't the capacity to absorb all that capital. And, just this week, we've got instances like Hanergy, and what are the consequences of just, moving too quickly would we just be risking blowing all that capital anyway by putting it into companies that don't necessarily have the governance on the alternative asset side?
There's a number of very large issues indeed, and there is no easy answer to that. Something needs to happen, and hopefully it will happen gradually. I think that will be very important. If there is a sudden shock and there is a crash of carbon-intensive companies, and money moves out and has to be parked elsewhere, that's going to be an issue. So a gradual change, I think, is something that is very, very necessary. But it's probably something, the way it goes now, that's a natural process, but it probably takes far too long. So it needs to be orchestrated in some other way. But frankly, I don't have that answer.
Philippe, you looked like you had a a point to make on the discussion?
No, it was just about the market failure. I mean, what we say that there is a market failure about the way the market is pricing carbon risk and oil companies. I mean, do you think this is the only part of the market where there is a market failure, or is this a bigger issue? I mean, because if not, I do not understand why it will be the only part of the market which is not really well priced.
I agree with that, and I think we have to distinguish between the obvious mispricing of CO2 emissions and what we believe about the pricing of fossil fuel companies, and those are two different things. So it's obvious that we don't have a proper price on CO2 emissions, so it's obvious that they don't have the right incentives to allocate capital properly. But at least in theory, that does not automatically imply that fossil fuel companies as such are mispriced in financial markets. Those are two different questions. Now, it may be the case that they are, but look at what's happened with pricing in the coal industry. It's been a massive repricing of these assets. So to say today that these assets necessarily are mispriced, we don't know that. We will know in retrospect, but we don't know ex ante, we don't know.
I just want to take this opportunity to invite questions from the audience, which can be submitted via Twitter. We'll be watching them here, so please do put forward your questions. I can see a few already coming up. There's one here. I mean, it's repeating the same point, really. Is there enough assets to meet the capital? Priya, do you have any view on that?
Well, I just wanted to make the point, one, that this highlights the importance not just of action at the individual corporate level, but also at the market level. And that's why we have been so engaged with the UNEP FI's inquiry into sustainable financial markets, which we see as a very important effort. And I also just wanted to make the point also that we are, in this discussion, we focused mostly on the public markets. We haven't talked a lot about the private markets, but that is also an opportunity, an area where there are, I think, quite a lot of opportunities, both for reducing one's carbon footprint and also for really investing for the future. So both in our real estate portfolio, our infrastructure portfolio, and our private equity portfolio, we're looking for opportunities that will obviously deliver a very strong return for the fund, but also make an impact over the long term.
So should we be looking at this increasingly as a growth opportunity story? And would that be something that would encourage a transition in an orderly manner?
I mean, if I could say, I mean, our financial analysts, when they've looked at they've done the demand analysis, it's a perfect storm of factors that are raising risks for the demand of fossil fuels. And one is climate policy, and some of the climate policy we've already got. So the emissions efficiency, or the efficiency for vehicles, has already had a huge impact on oil demand in the OECD. But it's also emerging technologies. So yes, solar, wind, electrification of vehicles, just energy, all the technology that companies, we've heard talk of the last few days, like Siemens and GE and Alstom and all these other companies are producing, is a huge opportunity. But also, so efficiency, but the rising capex of fossil fuels versus the dramatically falling capital costs of renewables. So I think the fossil fuel industry already today faces this perfect storm of factors that are affecting demand for their product and putting their business model at risk. So it's clear that there is a massive opportunity for the alternative technologies. And I'll come back to the point I keep making, sounding like a broken record, but we've already got to the point where many of the cleaner energy and cleaner technology options are cheaper than the incumbent fossil fuel ones. So we've got to stop talking as if the climate option is going to cost us more than the status quo. It's already the fact, without any more carbon pricing, with the carbon pricing as it is already, that many of these technologies compete favorably and increasingly without any kind of subsidies. But I think, again, the market and the business community in the world is slow to catch up.
Priya.
The one point that, that there are not limitless good ideas in this space. And we have experienced in the past, mid-2000s, a clean tech bubble. And so it's very essential that while we incorporate climate risk factors into our analysis of all private equity and real estate opportunities, we also must remain really disciplined in our investment approach. And we can't just be carried away by exuberance, which you know, we all see this as a, obviously those of us who are sitting up here, we all see this as a crucial and compelling issue, but we have to always retain our fiduciary hats on and be really clear and do good analysis to underpin our investment decisions.
Just, I like what you say about, I mean, always risk and opportunity. I think both are, we have to look at both at the same time. I mean, but there are a lot of opportunities. There are a lot of opportunities. It's not a question of trade-off between performance and carbon risk and climate change. This is the time we can just do the two at the same time. There are a lot of opportunities, of course, in renewable energies, but a lot of opportunities in many companies. We have seen yesterday and the day before during the Business Climate Summit, a lot of innovation with a very wide diversification in terms of asset classes, in terms of industries, sectors, and so on. And now we have also very powerful tools in order to redirect money into this kind of projects. For example, green bonds. I mean, we have not speak a lot about green bonds, but we are very positive about the green bond market. It's a way to really identify clearly the projects which are positive. And alongside with green bonds, we think that it will be very powerful and useful to have much more labels, green labels, that will show to the investors where we should invest. And not only institutional investors, it's also useful for private investors as well.
Mats, you wanted to respond?
I think it's important to stress that investing or addressing the climate risk or sustainability is not charity. It's a way actually to enhance your returns, but you need to have a long-term horizon when you evaluate. The problem is if you have managers being evaluated on a yearly or 2-yearly basis, sustainability is a random factor. But if you ask them to be evaluated, or if you evaluate them on 10 years, they need to take this into account, and it's a way to actually improve your returns, not the other way around.
Speaking of carbon costs, though, are we in a way asking too much of the private sector, given that the IMF recently came out with a report that identified that fuel subsidies run into the trillions at the moment? To what degree do we need to have an aligned approach with government as well? I mean, how can we be asking investors to pull their capital from fossil fuel companies when they are still being subsidized to such a degree? And NOCs, of course, but... Yeah.
Well, I mean, I think the report from the IMF and let's give some credit to the OECD, who've also done some incredibly good reports on this. One, they debunk much of the criticism we often get against renewable energy, that it's only viable with subsidies. Well, good, let's talk subsidies now. But I think if I was in the fossil fuel industry, I was an investor in companies, I would be very concerned now, because once I realize that many of the companies are so heavily dependent on these government subsidies, my view, I think, of the public policy and regulatory risk would go through the roof right now. So I would really be wanting to do the analysis and understand how those companies would fare if those subsidies are removed. And we're doing a piece of work on that and looking at our, overlaying removal of subsidies on some of our cost curves for some different countries, because I think that's critical. But I think you're absolutely right. But I mean, I turn it on its head and I would say, for governments who are desperate to replenish their treasuries and cash flows and spend money on public health and education, here's a great opportunity. Start paring back on those fossil fuel subsidies and use that money for education and for health, and level the playing field. Thank you. And the final point I would make, I think of this scale, this sort of seesaw And we have a slide that we use quite often with climate finance on one side of the seesaw and business as usual, fossil fuels on the other side. And at the moment, the fossil fuel bit, depending on what numbers you use, is something like 23 to 40 times bigger than renewable energy. But there's all this work going on to make to make clean energy, climate finance, more attractive, yet it's competing unfairly against investments that are the recipients of huge government subsidies. So why not just remove the subsidies and you level the playing field immediately? And as I keep saying, ensure the financial markets are correctly pricing the fossil fuel risk premium today.
Martin.
You're absolutely right that government policy has to be a part of this. Obviously, investors have a responsibility, but investors can only take responsibility for listed companies that they invest in, right? And it is, in addition to this issue of subsidies, there is the issue that a large part of fossil fuel production is actually occurring in state-owned enterprises that are not subject to the disciplinary mechanisms of MUTS and PRIA and other engaged investors. So governments have a role not just in terms of the subsidy policy, but also as direct owners of some of the largest producers of oil and coal in the world. So unless we get the governments on board and addressing this issue, we will not solve it.
Thank you. Is there anyone else who'd like to comment on the subsidy issue? Because I'm going to run through some of these questions that have come in otherwise. Any? So there's a question here that says, what does the panel think about Scope 3 emissions, and are they being included in current decarbonisation initiatives? And I have to confess, I don't know what Scope 3 emissions are, so if anyone could explain that to me at the same time, that would be great.
Emissions are broken down into different scopes. So Scope 1 is effectively your own immediate emissions of your own facilities, all the way out to sort of Scope 3, which is what are the emissions of your products. So, for example, and this has been, I think, news to many investors, the fossil fuel companies have been telling us for a number of years they all apply a carbon price to their business. And we all go, oh, that's good. But when you actually dig into it, you realize that when they apply that carbon price, it's only to their Scope 1 emissions of their own facilities. But they let you believe, or I think they have not rushed out to sort of clarify that when they apply that carbon price, it's not to the total emissions of their product. So for example, if Exxon or Shell or BP say they're applying a $60 shadow carbon price, that's only to the emissions of their facility and not to the emissions of their product. So I would applaud the French government who are now passing an energy transition law which requires all of the French investors and pension funds or asset managers to look at the total carbon footprint of their portfolios. That will include the Scope 3 emissions. So that what are the total emissions of all of the companies that you invest in, and therefore the total emissions of your portfolio. So that it is critical that we include these Scope 3 emissions when we talk about a company's total impact on climate change.
With Anthony, and that's, I think, the big difference in the change from traditional ESG investing towards impact investing. That's really taking into account the entire life cycle of the products that are being manufactured and sold and used and discarded. So I think it's absolutely necessary to look at the whole carbon issue from that perspective.
Anyone else have any thoughts on Scope 3 emissions?
The only point I would like to add is that you need to do this transparent, so you actually can see how you've done it and what the numbers are, to actually make sure that if you do it the wrong way, companies and others should have the chance to correct that.
Let's have another question. So how to prevent laggard investors from all rushing to the exit at the same time and provoke chaos on markets? Who would like to take that one?
No, I think this goes, and there was another question also on why cannot everyone divest at the same time, which I think is related to this. So, well, in equilibrium, of course, as long as these companies exist, someone will own them. and by definition, the average investor holds the market portfolio. So what will happen if very many try to divest simultaneously is, of course, that the equilibrium price will be lower, which means that the price you pay today to get expected future cash flows is lower, so your expected returns are higher. So, the fewer investors who want to hold these assets, the higher must the expected return on those assets be in equilibrium. So, and I think this goes back to this governance challenge that we need to think carefully about who we really want to be owning these assets. And I agree completely with what Priya said and also Mats about the effect of the divestment movement and how it has sort of concentrated the minds of many people. But I'm also a bit worried that we are about to concentrate ownership of these companies in the hands of investors who don't care and who will not be addressing these governance issues as much as Mats and Priya and other investors would do if they were owners. And that the disciplinary pressure on the capital spending of these companies will be lower. And that those laggards who are still owning these companies will be rewarded in the form of higher expected returns on top of that. So that's why I'm saying we need to have a nuanced approach. We need to have many instruments. I think the low carbon indices and divestment, it creates a market price for this risk. And I think it visualizes the risk. And it concentrates the mind of investors and companies. So I think it is a part of the picture. But it cannot be the only answer we have. And I'm really concerned about the lack of proper governance and the lack of alignment of interests. And I think we will never solve this problem unless we have active, engaged investors who really discipline management of the fossil fuel companies.
Priya, you've lost your mic. Oh no, it was stolen.
Philippe is trying to keep me from speaking, I think. Well, I think Martin has expressed very eloquently the argument for engagement. And really, in my view, the way to create an orderly transition is not to divest from companies, but to help companies or to encourage companies or to influence companies through their boards and through share owner action, share owner proposals, et cetera, to shift their resources, their investments towards more sustainable, towards a more sustainable way. So, for example, to move from offshore drilling to purchasing clean technology opportunities. That's really how we're going to collectively be able to divest from carbon risk.
Can I make the case for divestment, but with the caveat that Carbon Tracker does not advocate blanket divestment, but I'm not sure anyone else is necessarily going to make the case. The divestment movement is incredibly important, as the civil rights movement was, as the anti-slavery movement was, as the campaign against tobacco. I mean, it is engaging, young people, students, without trying not to be condescending here, but at a level we have not seen in climate change until now. I mean, it is giving them something that they understand and they can get involved in, and it is sweeping across university campuses. So I don't know if anyone's been to university. I have. I've taken part in several debates at a number of universities in the UK and in the United States, and the passion is akin to what you've seen in sort of films from the civil rights era. So do not underestimate that. I mean, that, in the short term, that's going to have a huge impact on the ability of the oil and gas companies to get people, because people coming out of universities increasingly are going to see them as stigmatized. But the divestment movement has, in many ways, made this real. Now, coming back to our approach, I think there is a case for divestment in some circumstances. Those companies that cannot or will not change. So we know the Rothschilds have divested, but what they told us is that was after 10 years of engaging with Exxon and others and feeling they had got nowhere, and finally it was like, well, what do we do? So those companies that cannot or will not change, so certain sole-play coal companies, certain tar sands companies, if that's all they've got, what can they do? Where do they go? So I think that's an important issue. I would again advocate the project level divestment, forcing the companies to divest from the high cost, high carbon projects. Then you win financially and you win from a climate perspective. Final point, what we're working on now in our blueprint is the benchmark. What does the transition look like over the next 20 to 30 years for an oil and gas company? Because without that benchmark, how do you judge on a collective cumulative basis whether your engagement is having any impact in taking us on a pathway to 2 degrees? That benchmark, that transition roadmap is critical.
Just quickly, I wanted to say that I'm not ignoring Miriam at all. I just, because of the translation device, I think it would be nice if we finish off. I'll ask her at the very end to give us an overview. But I also wanted to ask more widely, like your point about the, how this is giving students and all sorts of previously uninterested parties momentum to get involved. But is there also a dark side to that, in so much as it's all very well calling for this assertive action and divestment, but there is a question of wider implications if we just haphazardly get these companies to essentially shoot themselves in the foot so quickly. We are talking about, these companies employ hundreds of thousands of people, and there are jobs on the line, and there has to be an orderly transition that involves, to some degree, the workers that work for these companies and skills and education.
Look, I've said again and again, this is a transition. It's 20 to 30 years. We're not switching off the fossil fuel industry overnight. Within the 2 degrees budget, there's a lot of oil, gas and coal that gets burned. But let's do it in an economically rational way. Let's look at where is the low cost, low carbon fossil fuels, and we use that first, not stuff in the Arctic or the tar sands of the ultra deep sea that doesn't make climate or financial sense. I mean, interestingly, when we did the analysis, the stuff at the top of the cost curve is also the most carbon intensive. So there's a nice alignment there. Getting rid of those projects is good for the climate. It's also good for the financial value of those companies and for your investments. But I take your point, and you correctly identify the orderly transition. What would be disastrous for all those thousands of employees for the oil and gas companies is if they continue ostrich-like to keep their heads in the sand, and not all. I mean, there's many people in the oil and gas companies that talk to us, are desperate, find our work and our analysis and those of others like PRI incredibly useful to their case within the companies to change those companies. And I think, we all talk to those people within the companies who are working incredibly hard inside the oil and gas companies to make those companies transition. But what would be disastrous for those employees if we ignore this, month after month and year after year, and then we have the disorderly transition? Because then when the governments of the world realize we've got to solve this problem and nothing else matters, they won't care about how many people are put out of work. They won't care what happens to the share price of those companies or how many of their assets are stranded. It will be about solving the problem. And then you will see people, thrown out of those companies and onto the street in their thousands. In the orderly transition, we avoid that. We have an orderly transition by its very name. And the system, our financial system, is not threatened.
Priya, maybe you could expand a little bit about how, as an active, shareholder, what insight do you get at all into how some of these companies are preparing for a transition and how they are equipping perhaps their employees for that transition?
Sure that I am the person who can offer such insight, unfortunately.
Well,
but
from the perspective maybe that, as there's some concern maybe that on the active engagements front, these a lot of negotiations go on behind closed doors, and you have pledges from these companies about transparency. But to what degree, what are they really telling us? Is that enough?
Well, some of the things we've been advocating for is, ongoing operational emissions management, low carbon energy R&D and investment strategies, strategic KPIs and executive incentives, so aligning the incentives of the executive team with this type of agenda, and also engaging on the positive side with public policy interventions. So we're looking for greater support for true carbon pricing and the end of fossil fuel subsidies. But I can't say that the risk analysis and the business planning that we've seen so far has gone far enough. We are continuing, I mean, and very few fossil fuel companies that we've engaged have really even pledged to do this or started demonstrating this type of disclosure and reporting. So we're continuing the fight. We don't see it as a single year effort. It's going to be a multi-year effort, and we won't stop until we've got some satisfaction around that.
With respect to upcoming resolutions, what's your position on how people will vote? Do you have a view on upcoming, like the Chevron AGM, or are you and on BP and Shell? I'm following a question from here.
Well, I think we've seen with Shell and BP that the management is supporting the share owner proposals, and that is, I think, a very good sign. And we hope to see other fossil fuel companies following in that vein. I don't have a crystal ball. I wish I did, but I expect to see success there.
And Martin? Yes.
Just adding on that, I think my perception is that there's been a large change in attitudes just over the last 12 to 18 months within the fossil fuel companies. And I think this is, but of course, it remains to be seen how much substance there is in this. But the way that they talk about this problem is different now, to my ears at least. And these shareholder resolutions, which have been sort of controversial in the past, similar resolutions, have now been passed with the support of management in these companies. But now I think the next stage is when we get these stress test reports from fossil fuel companies that shareholders have asked for through these resolutions, that shareholders scrutinize those and see what the substance really is. And the next stage should be to use the sustainability reports as a basis for discussing capital structure and dividend policy, because we need to look critically at the investment capacity of these companies and what kind of projects they are seeking finance for. And I think one of the big risks we're running over the next few years is that fossil fuel companies, both coal and oil, will be using revenues from existing operations to finance new investments in new capacity, which will increase supply in the future. And I think it's quite, I mean, Anthony mentioned and others have mentioned that prices of renewable energy has come down a lot, which is correct. But the problem is that the new renewable sources of energy will have to compete with the marginal cost of producing fossil fuels from investments that have already been taken. And so if you compare average costs over life cycles between fossil fuels and renewables, renewables have come down and are quite competitive. But the sad fact is that they will have to compete for a long period of time with the marginal cost of fossil fuels from existing operations. And so the tragedy would be if over the next few years, investments are made which will give large supply of fossil fuels with low marginal costs into the markets for several decades and make that transition to a low carbon economy much, much harder.
But CapEx fossil fuels is going up.
Yes.
So in 2008 and 09, the last time the oil price was around where it is now, the average, I mean, there's some exceptions to this, but the average capital cost per barrel of oil was half what it is now. So the capital cost per barrel of oil, finding it and getting it out, has doubled in an incredibly short period of time.
I just thought maybe we could, Miriam, I was hoping maybe you might offer some perspective just to finish our panel debate on the role you play and the role perhaps emerging markets play as well, because really it's a much bigger ask for emerging markets in many ways to make these commitments. So would you like some closing thoughts, please?
Sim, sem dúvida. Temos uma especificidade grande, os países em desenvolvimento, os países emergentes, frente à realidade dos países desenvolvidos. Acredito que essa especificidade exige timings, ritmos diferentes entre essas economias, nessas economias. Para dar um exemplo, estamos falando aqui de energia limpa e renovável. No caso do Brasil, a participação da energia renovável na matriz energética é 73%, 3 vezes maior do que a média mundial. Portanto, desse ponto de vista, no caso do Brasil, é muito mais continuar mantendo essa participação na matriz energética, né? Quer dizer, nós já temos, digamos assim, por características naturais, essa lição de casa feita, digamos assim. Ela precisa ser mantida. Nossos desafios estão em outros campos. Eu acho que é isso, cada situação exigirá, dentro de uma lógica geral, de uma lógica ordenada, mas exigirá medidas diferentes adaptadas a cada realidade.
Thank you very much. I think we're coming to the end of our time. How much more time do we have? Do we still have a few minutes to have a closing thought from everybody? Okay, let's do that. Perhaps we could offer just a quick recap, or I could do the recap. But I was going to start with your point mainly, that the world has changed, and we have to communicate this message to the wider capital markets, because really I sit here on that side of the wall, and I am really, truly hearing all these arguments for the first time, and I think that's quite shocking in many ways.
Yes, and I think what's game-changing is comments on this issue from the Governor of the Bank of England, Mark Carney, and the inquiry announced by the Bank of England. The legislation that the French government is passing, their energy transition legislation, and requiring the disclosures by the portfolio managers. The fact that the G20, and we know, the French have been incredible here. The French Treasury are incredible here. They've been engaging other finance ministries and treasuries and doing an incredibly good job, and very much pushed for this inclusion in the G20 statement. So, kudos, as we're in Paris, kudos to the French government and the COP21 finance team and the Treasury. But the fact that, the G20 have asked the Financial Stability Board to investigate. I mean, we're in a whole new paradigm here, and so we're but a lot to do. So let's level the playing field. The elephant in the room is that the fossil fuel investments, many times renewable energy, but there's a lot of money there we can divert to climate finance. Let's ensure we start now and we avoid the disorderly transition, which would affect the very system, and let's correctly price the fossil fuel risk premium, and let's get financial regulators engaged. They cannot stay in grand isolation from the climate risk issue.
So, let me just say from my perspective, so the PRI has now about 1,400 signatories across the world, managing almost $50 trillion. What we see at the PRI is an enormous growth in the attention that institutional investors give this issue. And we see that in terms of the demand that our signatories have for analysis and support from us in their work on looking at these issues. I mentioned the Montreal Pledge, which is about measuring carbon intensity of portfolios, which of course got a boost with the announcement of the French government, but we are encouraging also, of course, investors in all countries to sign up. We're doing a lot of work on engagements, and I'd just like to reiterate one important engagement, which is the engagement that we have on lobbying. It is unacceptable that fossil fuel companies use shareholders' money to lobby against the long-term interests of shareholders, because shareholders are best served by having a price on carbon. So the PRI is doing a lot of this, and if there are any of you who are not signatories to the
if I may
PRI,
be so bold and to interrupt,
you should sign up.
could you please, yes, please be time conscious and keep your concluding remarks to a minimum. I mean, be as concise as possible, because we have another speaker coming in right after.
I was finished, but
All
thank
right.
you.
That's cool.
And I got the message. I think we passed the tipping point. There's no way back. We're moving to a more sustainable world, and the financial sector will definitely be part of it. The speed of this, I think, will be set by politicians and policymakers. If we get the right incentives, we will speed up, both as owners and I'm sure the companies will apply. And then on top of that, I would like to stress that there is not one silver bullet in how to deal with climate risk. Let the 100 flowers bloom. Thank you.
There's a big issue in difference in time horizon. This is all very long-term stuff. A large part of the market is not interested in long-term. They think the oil price is going up, let's buy some oil stocks. There's an analogy with quitting smoking. There's a responsible end. There are governments, regulators who want people to quit smoking. A large part of the people don't want to do that because it's too nice or convenient. So we have to work very hard on the responsible end to squeeze out the smoking together with regulators and governments.
Well, I am an optimistic person by nature, and I find all of the controversy and debate around this issue to be very energizing, and I am enthusiastic that all of us together, collectively, governments, investors, businesses, that together we will come to a set of solutions that will help drive us to a 2-degree economy.
I mean, what we need is clearly a big shift in asset allocation. So we need to understand, in the finance industry and also governments and regulators need to understand that finance is not neutral. And so they should use the finance industry as a very powerful tool in order to redirect the investments towards the positive infrastructures, companies and projects that we need.
Eu também queria manifestar meu otimismo em relação a essa agenda. Ela, sem dúvida, é difícil, mas eu acredito que nós vamos conseguir vencer esse desafio. Gostaria, por fim, de dizer que o governo brasileiro tem atuado fortemente nessa questão do clima e tem sido um ator importante para indução dentro do nosso país e também como líder dos países emergentes. Obrigada.
Thank you very much, everybody. That was really insightful, and I've learned a lot. Thank you.